Hello, folks. Welcome to the MAFATA Episode 5. So firstly, I'd like to apologize for missing a few weeks because this series is supposed to be once every 2 weeks. But during the last 2 weeks, I wasn't able to release one of the episodes. This is mainly because I was busy doing another YouTube video. So the video that I was busy with is this particular one. If you have not seen this, right, I highly encourage you to go and take a look, because in this video we cover a very important macroeconomic analysis that can cause a significant movement in the stock market itself. So whether or not if that is going to happen, we don't know, but it is good to be aware, and it is good to have some form of preparation in case it happens. Okay, so once again, if you have not seen this video, I highly encourage you to go and take a look. I understand from the screenshot, you can see the video is about 1 hour and 28 minutes long, but I have actually timestamped the video, so you can just skip ahead to the important portions, okay? So you don't really need to look at some other, I would say, less important one. Okay, so with that out of the way, right, I would like to also revisit some of the companies that we shared in our previous MAFATA episode in order to sort of do a quick welfare check to see how they are doing. Firstly, let's take a look at on holding. This is from MAFATA episode 2. So for this particular company that we shared, we actually entered trades on the 27th of June. It was actually entered on 15 June, and then it was further updated on the 27th. Okay, so in this case, our entry was somewhere around 28, and in fact, we did hit our potential target. We did hit the target price of $33 sometime around July. So currently, we are still holding some option position on this, and going forward, I do feel that this particular company, it has quite a good potential to go up even higher. However, at this current stage right now, the price kind of hit the resistance level, so we have taken profit on our previous position, and we are now kind of staying low for a while, and we shall see how we want to further how we want to put in another trade for this particular trade. Okay, so if you are not in the trade, you may consider, but I want you to be a little bit careful as we are hitting the resistance. So from MAFATA episode 4, we have shared our view on First Solar, FSLR. So once again, right, if you have not watched this, I do recommend you to go and take a look. This is mainly because we have recently just entered First Solar sometime last week, and we can see the trend line is kind of supported, and it is rebounding from the support level around 177. Currently, it is already at 190.82. Okay, so I'm not going to tell you where is the exact price we enter, what is our profit target, where is our stop loss, all this kind of stuff. If you are interested in finding out at what time did we exactly enter, or what are the trades that we are executing, right, do consider joining our Patreon subscription. You will have access to our private Discord channel where we share our portfolio. We share the kind of trades that we are entering on a timely manner. Okay, so that brings us to the topic for today itself, the FOMC meeting. So let's do a quick recap on what has happened over the past 3 to 4 weeks, because it has been a while since we do a MAFATA episode. Okay, so on June 14, we have the FOMC meeting, and during this meeting itself, the Federal Reserve announced that there will be an additional 50 basis point hike. So you can see here, the initial federal fund rate projection was 5.1, but on June 14, the federal fund rate projection is increased to 5.6. So the current rate is at 5.1, meaning to hit the 5.6 projection, there will be another 50 basis point hike incoming. Most likely, it will be 2 rounds of 25. So in July, we do have a FOMC meeting, and we may see that first 25 basis point coming up. Okay, so the reason for increasing this federal fund rate, the final target to 5.6 is mainly because the Federal Reserve is a little bit concerned about the core PCE inflation. So even though the inflation has been coming down, the core inflation has been somewhat stubborn, and they wanted to make sure that they are able to get the core inflation down. So how did the stock market respond to the additional 50 basis point hike? You can see here, this is the NASDAQ index, and during the announcement of the 50 basis point hike, the market didn't really care. The price rally from 14,900 all the way to 15,000. So the market doesn't give a shit about any increase in rate hike. After the FOMC, we did see the price kind of decline a bit, but after that, it sort of recovered back up. And as of today, the price is still above 14,900, which is the day of where the price was at during the FOMC. Okay, but it is actually getting resisted at 15,200, which was also the resistance back in 2022, where we have our first rate hike. So I do think that this 15,200 is kind of a major resistance, and it may be a little challenging for NASDAQ to break out of this. So even if the NASDAQ doesn't come crashing down, maybe it will consolidate at the current level for a few months before it decides to break higher, or we may see a sizable retracement perhaps towards 14,000. So what can cause this retracement? If you want to know, go and look at the video that I mentioned earlier. We have covered some of the macroeconomic conditions that could lead to NASDAQ coming down. So, of course, when we talk about rate hike, we also have to talk about the bond yield. You are looking at the 2-year bond yield. Because of the additional 50 basis point hike that is incoming, the federal fund rate will be at the higher rate. Hence, the bond yield have to increase in order to be competitive with the federal fund rate. So you can see that on the 2-year yield, the peak was actually around 5.08% sometime in March 2023. And recently, we just retested that level, and currently it is being resisted, and the yield kind of retraced back a bit. So I do think that this 5.08% yield on the 2-year bond, it is kind of pricing in the additional 50 basis point hike already, meaning to say that we may not see this break above 5% if the inflation start to decline, especially the core inflation. But if the core inflation kind of rebounded back up, then we may see the yield going above 5%. So this is something to take note of, okay? And the reason why we are mentioning bond yield, because it has something to do with the trade that we are going to share today. So next, since we are talking about yield, we also have to talk about inflation. So if we look at the inflation year over year, the last reading was 4%, and the consensus, the forecast for the reading for this month is actually 3.1%. So we are actually looking at another huge decline in inflation, or in the other word, deflation. We are looking at about 0.9% deflation for the inflation rate year over year. And of course, this is something good. As long as inflation is coming down, we'll probably see the end of the rate hike soon. However, what I want to point your attention to is the core inflation rate, because the core inflation rate is still relatively high at 5.3%. Okay, so the consensus is around 5%, meaning to say that the forecast, they do not expect the core inflation to decline as much as the headline inflation rate. So if we look deeper into the core inflation rate, you can see it peaked sometime around 6.6% last year, September, and it declined by quite a bit. But from December 2022 onwards, it has kind of remained stagnant and becoming a little bit sticky. You can see it has been around 5.6, 5.5, 5.6, 5.5. And during the May's reading, it went down to 5.3, which is actually good news. So we are hoping to see the core inflation go below 5%. If we see something like 4.9 or 4.8 during the upcoming reading, then of course it is generally good news for the overall market. Okay, so now that brings us to the trade that we want to share today. It is the TLT, the iShares 20-year Treasury Bond ETF. So what this ETF is simply your long-term US Treasury bond. So if you buy this ETF, you're actually buying US Treasury bond. And of course, since this is a form of ETF, if you are not a US citizen, you can actually buy this ETF to have exposure to the US Treasury bond. It is as simple as that. But what I want to point out is this is the bond itself, meaning to say this is not the bond yield. Bond price and bond yield are inversely related, meaning to say if the yield come down, we will see the bond price goes up. So in this case, if we see the 20-year, the 30-year bond yield declining, we should see the TLT recovering upward. Okay, so this trade is actually a long position on the TLT share. Of course, it doesn't mean you enter immediately right now. This is not the point, but I am just sharing our underlying theory for a potential long position. We do not have any position on this yet. We may enter it today, we may enter it tomorrow, we may enter it 1 month from now. We don't know. But at this point, we have no position yet. But sometime in the future, we may enter this trade. Okay, so the purpose of this sharing is to let you know our basis, our theory, our thesis behind this particular long position. So firstly, if we look at the TLT, sometime around October 2022, the TLT actually rallied quite aggressively by 19% from 89.89 all the way to 100.07. So it is important to understand why the TLT rallied during this period, because if we are able to identify the trigger and if we are able to forecast the same trigger will be showing up in the future, then we can definitely have a good long position ahead. So when the TLT rally, what this means is that the yield are coming down. Okay, the yield are coming down. That's why the TLT bond price is going up. So what actually caused the yield to come down? And of course, we have to look at the federal fund rate. So the federal rate hike actually happened sometime in March 2022. So when the initial rate hike happened, it was gradually increasing pace. We have 25 basis point hike. After that, we have 50 basis point hike. And then we have that 4 rounds of aggressive 75 basis point hike. So you can see that October period actually coincide with the last round of the 75 basis point hike. After that, the rate hike actually slowed down from 50 basis point to 25 basis point. So when the market realized that this is going to be the last 75 basis point hike, they expect the yield to stop climbing that aggressively. In fact, they expect the yield to start to decline, the bond yield to decline, because right now, the federal fund rate is not going up as aggressively, which is why you see the TLT rallying during that period, because market is no longer expecting the federal fund rate to climb as aggressively. Okay, so with this in mind, we can actually kind of forecast the next step. So during the first phase, the TLT climbed because the pace of the hike is slowing down. Then the next phase, it can be actually because the federal fund rate is going into a pause, meaning it's not going to climb anymore. Okay, the first phase is it climbed gradually at an increasing pace. That is when the TLT crash. And then the second phase is federal fund rate, it decelerate in terms of the hiking pace, and then we have the TLT recover. So the next phase most likely is the federal fund rate stop going up, it immediately pause. Okay, so that could be the next round of trigger for TLT to rally further. So the thing here is, what can actually trigger federal fund rate to do a pause? And of course, that is your inflation actually coming down, or more importantly, the core inflation declining. Okay, so as mentioned earlier, core inflation has been stuck somewhere around 5.6, 5.5. But if we do see core inflation start to decline at a reasonable pace, maybe we will be looking at 4.9%, and then we go down to 4.5, and then we go down to maybe 4%. If we do see core inflation going down to that level, then it will provide Federal Reserve with the data they need to do a pause. And when that pause happens, we expect TLT to climb higher. So this trade, it is a pure macroeconomic trade. We are not really looking at any fundamentals. We are looking from an overall broad market macroeconomic perspective. Currently, right now, you can see TLT recently have declined. It is somewhere around the support level, 97.99. And going forward in about, actually tomorrow, we have the inflation data coming out. And once the inflation data comes out, we will see what the data, how the data is like, whether the core inflation is going down significantly. And we see how the TLT respond, how the market responds in regards to TLT. And then from there, maybe we have a trade or we may not have a trade, but this is definitely on our radar. And another good thing about this TLT trade setup is that it is also a recessionary trade. Meaning to say, if going forward we have a recession in Q3 and Q4, then you may see this TLT skyrocketing even higher. It is not to say that we need recession for this trade to work out. In fact, we don't need a recession at all. We just need the inflation to improve. Then this trade will work out. But if there is a recession, then this trade will work out even better. So that gives us like additional insurance against any kind of recessionary things that is incoming, and it will give us good exposure or a good profitable exposure to any form of recession happening, even though the basis for this trade is not recession in the first place. So it is like something good to have, like additional insurance. So why not? Okay, so that is basically for today, short and sweet. If you like our sharing, do subscribe to our channel, and it will sort of give us a lot more view, and we'll be able to create more videos in the future. And of course, if you want to know in detail about our trades, what trades are we taking, what is our portfolio like, and if you want to join our streaming, you can join our Patreon. You can subscribe to our Patreon. It will give you access to a lot of other good information, and you'll be able to join our community on Discord. Okay, guys, thank you very much and have a good weekend. Sorry, I mean have a good week. The earnings weeks are coming up. Okay, bye, folks.